Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. Today, we're not just, scanning the headlines. We're actually taking a full-on deep dive. We've got a stack of critical financial stories here from sources like CNBC, Reuters, Yahoo Finance, Bloomberg, all the works. And our mission, really, is to cut through all that noise, connect the dots that might seem separate, and distill the most important nuggets of knowledge for you. We'll be unpacking everything from the latest twists in interest rates, the, red-hot IPO market, to global equity moves and that complex dance between geopolitics and commodities. Basically, we want to make sense of all these interconnected forces shaping your financial world so you're informed and ready for what's next. Right now, the overall market sentiment, it's been surprisingly positive, actually, some benchmarks hitting records. But as always, the real insights, they lie in understanding the complexities underneath. So let's unpack this first big theme. It's all about inflation, interest rates, and the Federal Reserve's next move. It sort of feels like markets are celebrating these new highs, right? But everyone's gaze is really fixed on the latest inflation data and what the Fed's going to do. We saw Treasury yields nudge a bit higher this Thursday morning, investors waiting for that critical inflation print. CNBC reported the benchmark 10-year Treasury yield, that key indicator, was up 2 basis points. And just a quick reminder for everyone, 1 basis point is 0.01%. And bond yields and prices, they always move in opposite directions. So a slight uptick in yields, it signals maybe a bit more uncertainty or perhaps expectation of higher rates coming from the market.
Yeah, and what's truly fascinating here is just how sensitive the market is to every little whisper of economic data. These movements, even the small ones, they're not just numbers. It's like, the market holding its breath, anticipating. And we saw a surprising prelude to today's news, didn't we?
Right.
With Wednesday's Producer Price Index, the PPI data. Wholesale prices, so prices from the seller's view, they actually fell 0.1% month on month. And according to Reuters, this was a complete surprise. Analysts were looking for a 0.3% rise.
A fall instead of a rise.
Oh, yeah.
And that unexpected decline, I imagine, sent a pretty clear signal.
Oh, absolutely. That surprise drop, as CNBC highlighted, it strongly reinforced market expectations for a Fed rate cut. It's like the market suddenly felt, more confident that this disinflationary trend is real and it's gaining traction.
That PPI surprise definitely got people talking. So now, today, Thursday, September 11th, all eyes are on the CPI, the Consumer Price Index. That's inflation from, your perspective, the consumers. Yahoo Finance says the August data is due 8:30 a.m. Eastern. Forecasts looking for headline CPI up 0.3% month on month, 2.9% year on year. And core CPI, stripping out food and energy, that's expected up 0.3% monthly, 3.1% annually.
Right. And this really raises an important question for the Fed and for us watching. If CPI also comes in soft after that unexpected PPI drop, what does it mean for the Fed's decisiveness? Will they act quickly? The market certainly seems to think so, almost with conviction, actually. Both CNBC and Reuters highlighted that markets are now, quote, fully pricing in a September interest rate cut, CME Group's FedWatch tool, Thursday morning. Put it around 92% probability. For a quarter-point cut, 25 basis points at the September 17th meeting. There's even like a 10% chance priced in for a half-point cut, more aggressive.
90%? Wow, that's some serious conviction. But is that collective confidence really justified by the data, or is it maybe a bit of speculative exuberance creeping in?
That's a fantastic point. On one hand, you've got the softening labor market data. Combine that with cooling inflation, especially that PPI surprise, it really does give the Fed more room, more flexibility to ease policy without that fear of, reigniting inflation. And this allows what some analysts, like on CNBC, are calling those animal spirits to soar in the equity markets. Investors are hungry for easier money. So every piece of data supporting a cut gets amplified, big time. However, and this is the crucial bit, that sheer unanimity, that 90% expectation, it introduces risk. If CPI comes in hotter than expected, even just slightly, it could seriously reset those expectations and create a volatility. So while the data supports the direction, the degree of certainty the market's priced in, that's pretty remarkable.
That's a really key distinction. Okay, let's shift gears. Moving from monetary policy to, the resurgence of IPOs, initial public offerings, and the incredible power we're seeing in the tech market. This is where those animal spirits seem to be truly alive. After a notably quieter period, the IPO market is just roaring back. Reuters reported Goldman Sachs is set for its busiest IPO week since July 2021. That's according to their CEO, David Solomon. He told CNBC that M&A activity, mergers and acquisitions, is up about 32% year over year. And get this, deals larger than $10 billion, up a staggering 100%.
Yeah, and this isn't just a flash in the pan. It's a real signal of renewed confidence. Wall Street banks have actually been hiring dozens of senior execs recently, specifically anticipating this recovery in deal-making. It shows a strategic shift towards growth, a belief that the tide has really turned. And a prime example, Klarna, the Swedish buy now, pay later lender. Klarna made its big New York debut on Wednesday, September 10th. Both CNBC and Reuters noted it opened above its expected range, finished up a solid 14.55% on day one. In fact, this whole recent surge in new listings, it's pushed an IPO index to a 3-year high.
And Jim Cramer over at CNBC's Mad Money, he thinks Klarna is, quote, still a buy at these levels. He explained that while it, roared right out of the gate, the stock hasn't gone to an insane valuation yet, and the numbers look good. He detailed that Klarna offers more than just buy now, pay later. There's consumer financing, budgeting tools, plus they earn advertising and interest revenue. And he mentioned their impressive underwriting standards. Now, they've been unprofitable since 2019, mostly due to growth investment, but management indicates profitability has been improving since 2023. Kramer did note, though, that a lot of the IPO shares were sold by existing shareholders, not the company itself, which is, a detail investors often watch.
Kramer makes some good points there. Klarna's valuation now, over $17 billion. That puts it in a strong spot. And he's right. Its public peers like Affirm and Cecil, they are profitable already. It suggests Klarna is, as he put it, headed in that direction. Yeah. But beyond the new kids on the block, we saw another tech giant, Oracle, make just a staggering surge. CNBC reported Oracle stock gained an astounding 36% on Wednesday, its best day since 1992. That single-day jump added $244 billion in value, bringing its market cap to $922 billion. 36% in one day. For a company Oracle's size, that's truly remarkable. What exactly triggered that kind of move? Well, it was sort of a 1-2 punch. First, reports of just gobsmacking cloud demand numbers, really astounding. And second, a blockbuster outlook for AI-related revenue. Oracle now sees $18 billion in cloud infrastructure revenue in fiscal 26, with an astonishing forecast of hitting $144 billion over the next 4 years after that. This isn't just hype anymore. It signals that the AI boom is shifting, moving from potential to actual large-scale enterprise revenue, maybe faster than many thought.
And the ripples were felt everywhere, right? This Oracle surge instantly revived the whole AI trade, sparked a rally in other AI-linked chip companies, utility companies. Reuters reported that. And what's even more fascinating, according to CNBC, SoftBank Group jumped over 10%. That came after a Wall Street Journal report about OpenAI's huge $300 billion 5-year cloud deal with Oracle. Apparently, it's part of that Stargate program initiative, the one announced by President Trump back in January, with, OpenAI's Sam Altman, Oracle's Larry Ellison, SoftBank's Masayoshi Son, all involved.
Exactly. That's a powerful mix, isn't it? Tech, AI, major global players, suggesting these deep strategic partnerships are really shaping the future of AI infrastructure.
Okay, let's zoom out a bit. Look at some global market highlights, regional growth. Because this rally, it's not just a U.S. thing. CNBC reported Asia markets are hitting records too, largely mirroring the gains we saw on Wall Street. Japan's Nikkei 225 notched a record high, closed up over 1.2%. South Korea's Kospi advanced nearly 1% to a record close. And China's CSI 300 jumped a significant 2.31%.
Yeah, this broad rally across Asia, it's deeply connected to what we were just talking about. Those Fed rate cut hopes, the positive inflation data. It's fueling global investor confidence. Combine that with strong corporate earnings, and it supports equity markets worldwide. Shows a very positive, maybe cautiously optimistic global sentiment right now. And reinforcing that regional strength, Reuters reported on JPMorgan Chase's big push into Asia Pacific. They're actually accelerating corporate banking hiring there, aiming to increase headcount by 20% next year. They even hit their initial 2025 staffing target way back in July, bumped headcount by 20% already.
Wow, that's a serious commitment to growth in Asia from a player like JP Morgan. What's driving that expansion, especially when others might be, cautious?
It's a few things, really. JP Morgan highlighted digital innovation, rising intra-Asia trade, and also increasing demand from Asian companies looking to expand globally. Oliver Brinkman, he's co-head of global corporate banking there, he noted it comes at, quote, a challenging time for some within the industry, which makes it, in his view, a great opportunity for them to expand and grab market share. And interestingly, he also kind of pushed back against that common China pessimism. Said JP Morgan's China business is actually growing 25% year on year. So it shows that even in tricky environments, there are still significant pockets of growth if you invest strategically.
Okay, shifting gears again. Let's bring in the energy sector, the complex interplay of commodities, geopolitics, and how investors are trying to, defend their portfolios. Bloomberg reported oil dipped slightly after a three-day gain, Brent hovering above $67 a barrel, WTI near $63. This little dip comes as the IEA, the International Energy Agency, now sees an even larger record oil surplus next year, with OPEC Plus bringing back production and rival supply also growing.
Right. And if you connect this to the bigger picture, the market is really grappling with a significant tug-of-war here. It truly is. On one side, you have these persistent geopolitical risks. Think Middle East tensions, Russia's recent incursion into Polish airspace, even President Trump questioning Israel's actions, as reported by Bloomberg and Yahoo Finance. These things usually push oil prices up. But on the other side, you've got rising global supplies and maybe a weaker demand outlook sort of tempering those fears. It's why you see firms like Citigroup forecasting Brent dropping into the low $60 by the end of 2026. They're pointing to that fundamental surplus. So it creates this very dynamic, unpredictable environment for anyone invested in energy.
And speaking of President Trump, we have this politically charged trade story from CNBC. Reports that Trump asked the EU to slap tariffs up to 100% on China and India for buying Russian oil, and said the U.S. was ready to mirror any EU tariffs. But the EU is apparently highly wary of doing that. Why the hesitation?
Well, it's a classic case, isn't it? Geopolitical goals clashing with economic realities and existing trade relationships. Both CNBC and Reuters sources kind of explain this. The EU is likely very unwilling to alienate huge partners like China and India. They're crucial for the EU's own economy. And adopting Trump's tariff strategy, that could also complicate their own, admittedly reduced trade relationship with Russia. I mean, EU reliance on Russian gas is down significantly, from over 40% in 2021 to about 11.6% this year. But they still need to manage complex energy supply chains. Meanwhile, let's be clear, the U.S. is pushing hard to increase its own energy market share in Europe, especially through LNG exports. We're talking $750 billion expected over 3 years. So it highlights this really complex map where energy, trade, diplomacy, they're all tangled up. And decisions have huge long-term consequences. As Goldman CEO David Solomon noted, this tariff policy stuff creates an overhang on markets. It impacts growth in ways that are hard to pin down exactly.
Right. So given all these global uncertainties, it's interesting to see how investors are looking to protect themselves. Reuters reported that Bridgewater founder Ray Dalio suggests gold as a way to shield investors from, quote, unhealthy markets overburdened with debt. He specifically recommends putting maybe 10–15% of a diversified portfolio into gold.
Dalio's view really underscores that traditional role of safe haven assets, especially in volatile times. His reasoning is that gold is largely uncorrelated with other assets, meaning its value tends to rise during a crisis or when other assets are falling. It offers protection against broad market downturns, currency debasement, that kind of thing. So in an environment where trade policies are contentious, markets are hitting highs, but with underlying jitters.
Yeah, a defensive play like gold makes sense for people looking to hedge. Okay, beyond these really big stories, zooming out just a bit, it's worth quickly touching on a few other things. Key data points, upcoming events that could influence these trends. For Thursday, September 11th, according to CNBC and Yahoo Finance, Kroger and Adobe are reporting earnings, so we'll watch those closely for corporate insights. Plus, the weekly jobless claims data from the Labor Department is out today, too. That ties directly back to our earlier chat about the labor market and the Fed, and in the crypto space, some notable momentum there. CNBC reports Bitcoin's up over 21% year-to-date since January 1st. Ether's up 30%. And this has helped many crypto-related stocks. Several have seen really substantial gains this year. Adding to the buzz, the Winklevoss twins are taking their crypto exchange, Gemini, public on NASDAQ this Friday. Finally, we should briefly mention how broader events, even tragic ones, can ripple through markets. CNBC and Reuters reported that conservative activist Charlie Kirk was shot dead Wednesday at Utah Valley University. President Trump announced his death on social media. In response to this tragic event, gun stocks like Grab a Gun climbed nearly 4%. Smith & Wesson was up 3.7%, extending recent rallies.
Yeah, it's just a stark reminder, isn't it? How broader events, even awful ones, can immediately affect market movements, reflecting investor sentiment and expectations in a very raw way, even on a day dominated by economic numbers.
So what does all of this mean for you, the listener, as you try to navigate this pretty complex landscape? We've seen this robust equity rally, right, fueled largely by tech giants like Oracle, strong hopes for Fed cuts, especially after that surprise PPI data. But we've also unpacked these interconnected global forces, from the tug-of-war in oil markets, geopolitical risk versus rising supply, to the tricky dance of Trump's tariff ideas clashing with EU trade realities, and even strategic bank expansions in Asia like JP Morgan's.
That's right. And the key takeaway here for you is that while market sentiment might seem high, really discerning the underlying drivers, that's crucial. From the nitty-gritty inflation data to those nuanced global trade tensions. Understanding that is key for informed decisions. Don't just react to the headlines flashing by. Try to understand the interconnected why behind them, how seemingly separate events influence each other. That deeper analytical understanding, that's your real advantage. It helps you anticipate, not just react.
So as markets scale these new heights, buoyed by hopes for rate cuts and the AI boom, what lingering cracks might surprise us next, whether they're in the labor market or global trade policy or geopolitical tensions? What could cause unforeseen ripples, and how might you best prepare? And that wraps up our deep dive into today's financial landscape. We'll see you all tomorrow morning with new headlines from major financial magazines.